grab your notebook and a blanket, and let's wind down together. Tonight, we will be going through some financial terms that everybody should know. So let's get on to the first one. The first term is budget. Budget. A plan of your income and expenses. It can be a high level or in detail. It generally will have categories such as bills, utilities, food, petrol, pets, debt repayment, etc. You can break them down however you want. The more categories you have, the more detailed understanding you will have of your spending. However, this might be overwhelming to keep on top of or identify themes in your spending. Remember, a budget is not about restriction. It is about controlling where your money goes. Emergency fund. An emergency fund is a pot of savings that is not to be used except in an emergency. General advice is to have 3 to 6 months of outgoings saved. However, speaking as someone who recently had an emergency, my 3 months savings didn't cover the bill. So if you can save up to £10,000, that would be a good number and should cover most emergencies. Sinking fund. Similar to emergency funds, sinking funds are pots of money that are saved for specific reasons. This could be a holiday, hair appointments, a shopping spree, or for Christmas and birthdays. Anything you know that you have coming up that is an expense that you may need to budget for. Credit score. Your credit score is a 3-digit score to express how responsible you are as a borrower. A higher score indicates you are less of a risk to lenders and you can access lower interest rates on loans as a benefit. Things like paying back debt on time, lines of credit, and being on the electoral roll can impact your credit score. APR, or annual percentage rate, indicates the interest you pay each year on the money you have borrowed. Compound interest. Compound interest is the amount of interest added to the debt or assets based on the initial amount plus the interest accumulated over time. Compound interest therefore grows at a faster rate than simple interest. Assets. An asset is anything you own outright that adds financial value. A huge misconception is thinking that a mortgaged property that you live in is an asset. If you still owe money on the property and are not renting it out to generate income, this is actually a liability. Liability is any debt that you owe. This could be credit cards, mortgages, loans, etc. Net worth. Your net worth initial purchase value. It is only realised when the asset is sold. Be aware that in the UK, this will incur what is known as capital gains tax. Diversification. Diversification refers to spreading your investments across different assets to reduce risk. This can be savings, investments, bonds, properties, just to name a few. Think of the term not putting all your eggs in one basket. Envelope or cash stuffing is the budgeting method of only using cash instead of bank cards for the month. The cash is divided into different envelopes for different areas of spending. One for food, one for petrol, one for activities, etc. You can have as many envelopes as you need. However, you can only spend what is in that envelope, and once it is empty, you can no longer spend on that category. This way, you are more conscious of how much you are spending in different categories. Again, it is about controlling where your money goes. Gross income. Gross income is your total income before any tax or deductions are made. You may have seen the meme that helps me remember the difference between gross and net income, because it is gross to see how much they take from your payslip. Net income is the actual take-home amount after all taxes and deductions are taken. State pension. The state pension is a regular payment that can be claimed once you have reached state pension age if you have contributed enough to the National Insurance Fund. The state pension is different to a private and a workplace pension in the UK. ISA, or individual savings account, is a savings account that has tax-free interest benefits. In the UK, every person has a £20,000 tax-free limit per tax year. I hope you enjoyed our quick run through some financial terms that will help you in everyday life. To recap what we have gone through, we have gone through what a budget is, and more importantly, that it is not about restriction, but about controlling where your money goes. An emergency fund and sinking funds, and the main differences. What a credit score is. Your APR on any debt. What compound interest is, as a very quick overview. The difference between assets and liabilities, and how you use them to figure out your net worth. What capital gains is. Diversification. budgeting method of envelope stuffing, the difference between your gross and your net income, the state pension, and your tax-free individual savings account. These are just a few financial terms amongst many, many confusing words. Most of these terms are not explained through school, even if you take the business class. So you should forgive yourself for not knowing what they are, and give yourself some grace that you are deciding to learn now. If you found this useful, please feel free to hit the like button and subscribe for more useful finance videos. Thank you for spending this time with me. Remember that money doesn't have to be overwhelming, and looking at your finances is a small step